Earnings are coming in thick and fast from both sides of the Atlantic at the moment, and all corporates are having to think about rising interest rates on the back of rising inflation and a consumer under increasing pressure as energy bills rise. Is there any place for us traders and investors to hide in these volatile times? Well, welcome to this edition of IG Trading the Markets podcast. I'm Jeremy Naylor. We're joined today by Chris Bailey from Financial Orbit. Chris, it's great to have you back on with us here, and it's good to be able to get your commentary around what's happening. And indeed, I'd like to start from that angle, if I can, to ask you what you make of the current environment for the markets.
Well, great to be here, Jeremy. Thanks very much for that. It's a difficult time, clearly, but not impossible. That's always what I think to myself and say to everybody. It is tricky. We've seen a lot of volatility in markets year to date, but we had a very strong market in July, the best bond and equity market for well over a year. And we've also had a fascinating earnings season. So that tells me, given all the challenges out there, it's even more important to be active, to be thinking about where their investments are going and not just looking at the past and saying it's going to continue like that, because patently the world is not like that at the moment.
So what should we be looking for then as opportunities now? I mean, the environment is febrile, to put it mildly. We don't know what's happening in Ukraine, clearly. It's obvious that interest rates are rising, making it more and more difficult for those that are used to the loose money environment. And as I said, companies are having to deal with rising inflation. So what's the end point?
I think there's two things really that become important. The first is you do still have to think about macroeconomics. I know it's boring, but it is important. And macroeconomics obviously captures things such as interest rates and inflation and what government policy is doing, geopolitics too. That's always important, but that's only, I would say, 25 or 33% of the story. The majority still, and perhaps people have not looked at this as much really in recent times, is looking at what companies are actually saying, what an individual company or a sector are saying. And you get that best, of course, from earnings season. That's always a fascinating time to get corporate insights on, but also additional commentaries that you get, not just the movements of shares, but also what companies are saying about their progress and their fears, their risks and related. And this is why I think really for individual investors, this is a fascinating time to be an investor, because as an individual, you can add a lot of extra insight and thoughts, pull it all together to really help you manage a better portfolio. So a bit of everything really, but actually it's becoming a time when you just can't buy a bit of almost anything. You have to pick and choose much more carefully. And that's what makes it a much more exciting and active marketplace for all investors all around the world, frankly.
And of course, a lot of people are asking where the bottom is. We've been talking to clients over the last quarter or two. I mean, take Facebook for an example of the point I was going to mention. It's the fact that a quarter or so ago, Facebook was down 40-odd%. Here we are now down 60-odd%. People thinking it can't get any worse, and it does. And much of what's happening, of course, in that particular sector is the way in which these companies are trying to monetize profits. And then you get Snap, 20% down a day because it can't see an end to the pressures building in digital advertising. And then all of a sudden you get word from Google, let's just say, as an example, all of a sudden things looking good and it on the way up. There doesn't seem to be a consistency of messaging across these companies anymore. Is that, well, I suppose the question is why, when they're operating in what is essentially the same market?
Because ultimately, the world of investment is, I know it's complex and tricky, but actually there's a simplicity to it as well. If you can sort of mix through all the difficult messages and macroeconomic challenges or opportunities or everything else, you can be aware of the macro view, but ultimately a company is driven predominantly, and as I would say, it would be 66% or 75% driven by how they are doing as an individual business. And therefore, some of the boring and traditional matters become the most important. Are they making a profit? How much is that profit going up? Are they generating some cash flow? Are they paying a dividend? How is that progressing? How are their costs doing? What's their supply like? All of these things which investment analysts understand, but sometimes you just don't ever look at that horrible detail. And this is why earnings season is so important, because it's that free information for us all. And so to talk about some of the names you just mentioned, it's fascinating to compare the Alphabets, the Googles of this world versus the Metas, which I still, because I'm so old now, think about as Facebook. And the reason why they're so different is because Alphabet is generating cash and building more profits, which is great. And you can debate whether that justifies the valuation or not. But it's an easier story than, let's say, a Meta, who are having problems in growing their business in areas such as Facebook, of course, and hence profitability. And they're investing a lot of cash into new things which I barely understand, like the meta universe and stuff. Now, that might be a genius move, but it causes uncertainty. And it means, as investors, we need to think in a slightly different way. And consequently, you never invest aggressively or put a high forward multiple into an area such as that, where you've also got challenges such as higher interest rates and new things, as you say, which didn't exist 5 or 10 years ago. So it gets more complex in a way, but actually to me, it becomes much more like the times which I learned to be an investor in, more like the 1990s or the early part of this century. And that's really the change that I think investors have to just accept. The last 10, 12 years have been fantastic. We've had some challenges, of course, most recently, clearly COVID, but generally over that 10, 12-year period, it was wonderful. I think that the rest of the 2020s are going to be trickier. And as a consequence for investors, they need to understand slightly more boring things such as profits and cash flow and the likely direction of those over upcoming years, and hence whether a share is cheap or expensive. And my guess is, and this is where it gets tricky, when I look at all the key sectors around the economy or the markets, be it technology or be it energy, be it industrial, be it almost anything you could mention, I reckon you can find interesting and good companies and also bad companies and expensive companies in all of those sectors. And that's what a truly active market is like. It's not that any tech company is going to be great or any energy company is going to be useless. It's going to be a combination of the two, which makes it very exciting, but also tricky. But that's life.
Let's steer the conversation in that case round to one of those companies that does come from the old idea of investing for the long term and dividends and so forth. That's the oil sector. I'm steering, as I always do, towards your Twitter feed in the morning, because you comment on a lot of these companies at financial_orbit. Now, one of the companies you spoke about this morning was BP, and including in this conversation, I want to bring in the fact that Chevron last week and ExxonMobil both shattered previous earnings records. As of the time of recording, BP has just posted its second biggest quarterly profit on record. But at the same time, there's criticism, of course, of these very same companies benefiting from the pain that us consumers are going through with rising energy prices. But at the same time, the company's raising dividends, it's paying investors back, it's paying corporation tax as well. And you've got to be mindful of the fact that this sector, a couple of years ago, was making massive losses. And so this is all part of the cycle, I guess. But what are your thoughts on the oil sector? Have we got as far as we've got, do you think, on the upside, or is there more to come?
My guess is, and perhaps captured by my comments earlier today on BP, but certainly when I think about US companies, Exxon or other main names, Shell, for example, in the last week too, my feeling is if you're a dividend centered investor, if that is your main focus on life, mainly because of where you are in your investment career, then the sector is going to be absolutely fine. You will get more dividend yields out of energy than you will holding cash in the bank or in bonds or something akin to that. However, if you're a total return investor, if you're looking for not just only dividends, but also growth, also the capability for a share price to increase, I think it's actually going to get a bit tougher for the energy sector. And it's not because the oil price or the gas prices at the moment are not attractive and highly profitable for them. That is patently true. But it's just that when I look to the rest of the profile for this decade, it gets trickier. And it gets trickier for a few reasons. It's not just the fact that the world is changing and evolving in terms of how it's looking at energy. And it's certainly not just because of ESG matters or anything like that. It's because actually, I think perceptions towards the sector has improved markedly over recent months. And consequently, almost people have become now too optimistic about the area. And that's why my thoughts have been actually to sell my exposures as this year has progressed, as we've seen firm prices and everything else, because I actually now am looking at areas which are less appreciated by the markets. And this is why I think it is an active investing world, because we are going to have to accept that changes are not going to be for 5 or 10 year periods. They're going to be a little bit more for actually a period of time that I always used to like, that sort of 12 to 18 month period where we go from one sort of area of focus and sort of it evolves to another area of focus. It's not that you have to day trade. I know some people do that very well and they're very clever at it. I'm not. I'm a bit more of a medium to longer term investor, but actually that time duration, I think at this moment in time, is moving towards a 12 to 18 month view. And consequently, energy's done fantastic over the last 12, 18 months, technology less so. And that's why I say, actually, I'm looking into both sectors for opportunities. But in energy, it's actually to reduce positions. But in technology, it's to do the opposite, to actually look for opportunities that haven't been fully appreciated by the market and still remain interesting. And that's the same in everything I look at, be it industrials, pharmaceutical, consumer, all have their good points and bad points. But individual companies with their particular rationales and drivers and instincts can make them very interesting, or in other cases, extremely boring and must avoids. But that's the investment world for you. That's always how it is.
It's interesting, isn't it, as well? I mean, BP this morning, good example, issuing a share buyback, what, $3.5 billion or something, whatever it was, I think that was going to be fed back in, or they're buying back shares. And what does this tell us? Because like me in the morning, you look through the RNS list and there are so many companies now buying back their own shares. What is going on? What's the motivation behind this? And what's this tell you about perhaps maybe the part of the cycle we're in, or about the individual companies themselves?
Yes, I mean, theoretically, buying shares back is fantastic because if you buy shares back and reduce the number of shares, in theory, it pushes a share price up. And that, in theory, sounds a good thing. I think companies are doing it for two reasons. There's the good theoretical reason, which is that it is the best thing to do. They can't find anything else to do. They can't find businesses they want to invest in. They can't find capex they want to do. So therefore, the best thing to do is to return the cash. And that's pretty rational and makes sense. I think that most companies buying back shares are not in that position. They're thinking, our shares are cheap. Actually, we've got a lot of cash. In fact, many companies in more recent times, not BP, but many other companies have borrowed money or got very cheap lendings out there and said, well, actually, we can buy back our shares more cheaply than it costs to fund that. And that becomes very dangerous. What typically I've found over not too long, I guess, but certainly in the last 25 odd years over
Yeah.
my investment career, is that when I've seen peak buybacks, it's actually just before markets get worrisome, volatile, or in some cases have fallen materially. That's often the case. And I find it slightly concerning that if companies are buying back a lot of shares, actually, I think it will sort itself out. Because as we see this year progress, as many companies have said, matters have changed a little bit. Perhaps consumers are a bit more aware of issues. They're not spending as much money. Companies are therefore having to be a bit more cautious and careful. I think they're going to be a little bit also more cautious about buying back shares too, in the sense that not that their share price is too high or too low. It's just a question that they can do some other things with the capital. And I would be more excited about companies who say, actually, we're not going to buy back shares. We will keep on eking up our dividend, of course, but we can find some good capex to do, or maybe even buy some other companies that we actually like the look of over the next few years, because market volatility has given us opportunities there. And when I look at some names, we're starting to see a little bit of evidence of that. And that's a good thing. I mean, for example, just to switch a little bit from energy to mining, I see some interesting shifts there where companies are saying, actually, we see some opportunities to put some money to work rather than we keep on returning cash as dividends or buybacks. We're going to do a bit more capex because we find ways to develop our business, which takes a long time to do over upcoming years. I think the oil and gas companies, energy companies in general, they have that debate at this moment in time. And obviously for them, it's extremely broad in the sense, and it's not just oil and gas and related products, but it's also green energy angles, which they're going to need to develop. But actually the names, at least in the UK, or at least the UK listed names, the BPs and Shells of this world, have been a little bit more pro doing that rather than names such as Exxon and other US players. But we shall see how that goes. My observation, though, would be that optimism, enthusiasm towards the energy sector is a little bit high at the moment. By contrast, mining focus has actually come down a lot over recent months. If I look at not just copper and related areas, but stuff such as gold. And I find that very interesting because I actually see some very attractive opportunities there when I look through into the late 20s and into the 2030s, which to me as an investor makes me excited. So again, more insights, potential from the earnings season on all of this, I would feel.
Mm. How do you feel about the opportunities that are provided in the current cycle of raising interest rates? I mean, there is clearly interest rates are going up because of inflation. Inflation is eroding cash, so you don't want to be holding cash. You want to be doing something with your money. How do you take advantage of this situation where you've got rising rates in a rising inflationary environment?
The key is pricing power, as it normally is. And again, it's something which was very traditionally a thing to look at a couple of decades ago. But in more recent times, it's become less of a focus because seemingly most companies have the capability to raise their sales and their profits if they had a sensible product. Walmart, for example, um, having sort of challenges with perhaps keeping up their pricing power because their own consumers are being very reluctant to spend money. And that is a very important matter, therefore, in any sector. So pricing power to me is the absolute key. Now, pricing power can come from, in some extreme cases, from an absolute essential need for a product, but there's not so many of those. Most products have a cheap alternative, which may not be as good, but it is cheaper if you desperately need a new car or a chemistry or a chemical or a pharmaceutical product or something like that. The real key, I think, is to have that ability to either raise your price and still have people buy a good amount of your products. And for example, when I've looked at a lot of the consumer companies recently, when I look at the comments from the Nestle's, the Reckitt, Benckiser's, to some extent even the Unilevers of this world, you've seen some good capability to do that. And so I think pricing power is a very important focus. And it used to be that you would be guaranteed to have good pricing power in certain consumer or pharmaceutical areas. It's become trickier nowadays. And it, ironically, is not because of aging populations. That should be a positive. It's just that people have less money to spend. And it's not just individuals, it's also some companies too, who suddenly have realized that they need to lower their cost base as well. So yeah, pricing power is the thing to look for. And that is the key thing. It's not just your ability to raise prices, but also to have new products that justify firm prices going forward too. A really important focus, I think, for all products and all companies over the next few years.
Just one final question. Over the next few months, what are we going to be talking about, do you think, at the end of the year? What do you think is going to be the subject that will be focused in on as we close out we're now into the second half of the year, but clearly looking into the third and fourth quarters? What is it, do you think, that's going to be occupying our minds?
Okay, so unsurprisingly at the moment, everyone is still talking about, is there going to be a recession in 2023? Some people, of course, would argue, as per the recent US data, that there's going to be a recession in 2022. I actually think that is the wrong way to look at things, in the sense that not that I'm a massive optimist saying there is going to be no recession, but as always, markets always tend to look about 18 months, 12, 18 months ahead. And consequently, I think this huge, or at least material pessimism at this moment in time, whilst there's some good justification for that, geopolitical matters, raising interest rates, still firm inflation, I think these issues will have been largely factored in. Even though uncertainties can always happen, I think there's a great level of pessimism there already. And so whilst would not be surprised to see much lower inflation, let's say this time next year, consequently, I think the debate about whether there is an overt recession in 2023 is going to be still an important one. My view is that there won't be, and therefore, I think the important thing for investors to think about as this year moves towards its conclusion over upcoming months is which companies are going to surprise positively next year. And this brings us back again to the debate about who has pricing power, who actually has a sensible balance sheet, who is going to be still generating free cash, who is at an attractive valuation, which areas have been fallen out of favour erroneously, and will actually look far better in 2023. As always, the investment markets, we all know this, it's a forward-looking game. And that's what's going to make this active investing world so interesting. So I'm excited. If you ask me which sector it's going to be, I'm going to stick with my previous comment. It's going to be actually all sectors, but the important component is it's by no means everything in all sectors. It's going to be that active investing, picking and choosing carefully of not just in an individual sector, but across all sectors. And actually, I'd say the same thing in economies too. For me, the US market still looks a little bit expensive, but because it's had such a wonderful last decade or so, I would say the emerging markets look cheap, but it's not as simple as that, that you can buy a whole load of emerging market shares and sell a whole load of US ones. I think it's much more complicated and interesting and kind of a bottom-up kind of investment focus than perhaps those observations would say. So to me, an exciting, interesting world, a world where active investors who are thoughtful and careful and do boring things like look at earnings season and understand matters like that will do well. So I'm excited actually about the future. And certainly as I think about my pension fund, I think about the importance of the rest of this decade and next decade, and I'm not going to talk about the 2040s yet. That's the important and exciting thing. There is still so much to do. The world has its challenges, but slowly the world will continue to get better. And that's the most important thing for all investors. I'm afraid cash and bonds still don't excite me. Certain minerals still highly excite me, but boring old range of different equities is still going to be the best place for the core part of most people's portfolios. It's just a question of choosing the right ones. That's the only small challenge.
Okay, Chris, look, it's a pleasure. Thanks indeed for joining us. It's been great to be able to catch up with you. Chris Bailey from Financial Orbit, and you can catch up with Chris most days when he is on his normal routine of commentary around some of those stocks. As he was saying, we're right in the thick of earnings season, and it's really all happening at the moment.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.